If you just look at this comparison and compare to global markets, there are a lot of markets which have done very good. I mean, like Japanese market, Brazil, China, UK, even Korea, although Korea is not there in this slide, they have given very strong returns. While markets like India, US actually have underperformed. Allocation between fixed income, equity and gold in case of multi-asset fund. I think one of the sectors which is very attractive today in terms of valuation is the whole financial services sector. So we also have a banking and financial services sector fund. I think the issue what happened with that sector is that in last 1-2 years your inflation was very low, so your nominal GDP growth was at 8-9%. So your credit growth is linked to the nominal GDP growth, so that was also very weak. What I'll do is that I'll spend some time initially on market insight, what is my view, how do we look at valuations and what kind of returns I think we can expect over next 12 months in the markets, and what are our recommendations in terms of investing clients money. I also manage the mid cap fund and the focus fund. So I'll spend some time on how I manage my portfolios, how I look at portfolio construction, my investment philosophy, just to get a sense that since I'm here, just to give you an idea that how a portfolio manager constructs his portfolio. And obviously, if you have any questions on anything, we can take it. So starting with the markets and valuation. So I mean, if you just look at what has happened in last 1 year, 1 month, 3 months, and 1 year, and obviously the 1 year returns look very positive, mainly because this is 1 year data as of Feb end. So we do this month end generally. Now actually we are close to March end, but this was done at Feb end. And if you remember correctly, last year from September to Feb there was a sharp correction in the market, specifically because of the tariff and other issues, and obviously because of that your returns are positive. But if you look from September 24 to today, which is 18-month period, actually market returns are quite negative. So the 1 year returns look positive because of that. But having said that, I think one of the things you will notice is that if you look at any time period, 1 month, 3 month or 1 year, one of the sectors which has done very well is the PSU bank sector, other is the metal sector, and lastly is the banking sector, and auto sector has also actually done very well. These are the 4-5 sectors. Overall financial services, within that PSU banks, metals and auto, these are the sectors which have done well. And on the other hand, if you look at the sectors which have done very poorly are IT sector, the real estate sector and the FMCG sector. These three sectors have done quite poorly. And if you just look at this comparison and compare to global markets, you will look at that on a 1 year basis. There are a lot of markets which have done very good. I mean, you like Japanese market, Brazil, China, UK, even Korea. Although Korea is not there in this slide, they have given very strong returns. While markets like India, US actually have underperformed. And if you would have seen this same slide, say 18 months back in September 24, when Indian market was at peak, actually it was exactly reverse. India and US markets were best performing markets, while all other markets had not given any return. Like the Chinese market and the Japanese market had not given any return for many years, maybe even 10 years, and that has now reversed in last 18 months. And one of the big factor for that is the valuation, because India and US markets valuations were high, they are still high compared relative to other markets, and while the other markets were very cheap, and they also saw an improvement in their earnings growth. So because of that, you saw strong performance by other markets, while Indian market, which was expensive and also had a muted earnings growth, which I'll show ahead, which led to this impact. So if I now just go to the earnings trend, see, I mean, one thing you have to always understand is that there are two reasons because of which you get returns in the stock market. One, if your earnings have to grow, or your valuation goes up or down. So either your PE multiple has to go down, or either your earnings have to grow. A combination of two or either of them leads to market returns. Now, if you look at it, and we have this long-term data from 1993 till now, we have till 2028, which is the expectation. So a long period of data, almost 35, more than 35 years of data. And if you look at it longer term, your Nifty has given, Indian markets have given 12% earnings CAGR, and that is the long-term return you have also seen in large caps specifically around that level. But within that period, you see there are very cycles. There are cycles of strong earnings growth and there are cycles of poor earning growth. And if you look at from March of 2020, which was in COVID, till March of 2024, you had a very strong period of earnings growth, almost 19% CAGR in earnings you saw. And if you remember, March of 2020, market corrected and valuations were also very cheap. So you had a period of very good earnings growth, almost 19% CAGR. And top of that, you had valuations which were cheap, went up. A combination of two, which meant you had for 3-4 years, you had a very strong market return, almost 25% earnings returns you saw. Now, what happened in last 2 years specifically is that, as I said, in September of 24, market peaked. And at that time, valuations were very high. I'll show you in the next slide the valuation also. But along with high valuation, what was the problem was that if you look at March of 25, last year, financial year, you had only 3% earnings growth. And if you look at March of 26, which is ending in 3 days, the financial year, you have only 5% earnings growth. Now, if you have a combination of very high P multiple and very low earnings growth, it generally leads to market correction because your valuation will also derate and earnings growth is also weak. So that is the problem which has happened. But I think going ahead, things are looking much better. One, because your valuations have already corrected. I'll show you Nifty valuations going ahead. And secondly, if you look at next 2 year expectations, it is expected that earnings growth will recover to 12-13%. I know there is a lot of uncertainty because of war and a lot of other inflation is going up, crude is going up. But even if this 12-13 say goes down to 10%, it is still better than what was the earnings growth in last 2 years, and the valuations have also corrected. So I am definitely more positive on the markets over next 1 year compared to I was in last 1 year. So now if you look at the valuation, I'll just focus on the trailing price to book, which is easy to understand. If you look at the Nifty 50 trailing price to book, again this is as of Feb end. Actually market has further corrected in last 25 days, so it has further gone down. Now if you look at the long term 10-year average of Nifty 50, the yellow line, it is 3.1 times. Today we are at, as of Feb end, we were at 3.06. Actually we have further corrected maybe 5%. So it is now around 2.9 times. So our valuations have now gone below average. And in September of 24, what I was showing, if you look at the top peak there, it was almost 4 times. So valuations have become very expensive. So now valuations have actually come below average. I would say they are very attractive now. And earnings growth expectation is also that it will revive. And if you look at the ROE of the Indian markets compared to average and compared to pre-COVID, it has also improved. So all put together, I think if I have to take a guess, I think my view, next 1 year, I think market should give you decent, maybe around 15% returns over next 1 year, considering that valuations have corrected and earnings could also improve. So in the large caps, in Nifty 50, I think we can expect a 15% kind of returns over next 1 year. But if it comes to mid cap and small cap, the issue is that valuations are still expensive, although they have corrected from their peak. So if you look at the valuations, at the peak, obviously mid cap valuations touch all the way to 6 times price to book in September 24, just an average of 3. Now they have corrected, and maybe they have corrected further to say four times in the last 1 month. But still, this remains significantly above average. While in large cap we saw they have come below average, here it is still significantly above average. Same for small cap. At the peak, it was at around 4.6 versus average of 2.4. Maybe today it has come to 3.2 times, but still corrected from peak, but still significantly above average. So that is why the mid cap and the small cap index don't offer that kind of valuation comfort which we see in large cap. Hence, what we are recommending for now is that if you have to invest lump sum money of your client, you should invest in either the large cap oriented funds or hybrid oriented funds like a balanced advantage fund, multi-asset fund. But for small and mid cap, the suggestion is that you should continue to invest using SIP or STPs and not do lump sum for now, because if because of whole geopolitical uncertainty there is a further correction in the market, they could see a more sharper correction compared to large caps. One more thing I wanted to share is that this is a framework which we have created. So we have 2 asset allocation funds. One is the balanced advantage fund and the other is the multi-asset fund. In that, we have actually created an in-house model which recommends to us what should be the allocation between fixed income, equity and gold in case of multi-asset fund. And this is the model. Basically, what we have done is that we have divided it into 5 buckets, and based on the valuation and the 3-4 parameters, it suggests what should be the equity allocation. Again, this is as of Feb end, and as of Feb end, we were in this lower end of the yellow section. In fact, now we would be in the light green section, I think. So these are the basically the orange, the top is the most is the phase when market is very expensive, which happened in September of 24, which we call decrease equity allocation. The dark green is a phase when market is becomes very cheap, which we call significantly increased equity allocation, which actually happened during COVID. And then obviously there are in between periods. Today we are in this light green phase. Now if you look at it, we have done the study in whatever phase the market is and what is the average return you can expect for over next 1 year, is that if you look at today we are in this light green phase, and whenever market is in this phase, on an average market has given you 14% return over next 1 year. September 24 we were in this phase, and in this phase the average return is only 3%, and that's what we have seen, the very poor returns in last 18 months. I think whichever way I look at it, the fact that earnings growth is 12-13%, valuations are below average, and this model, I think the conclusion remains that you can expect a 15% kind of return from Nifty. So this is again for Nifty 50, which is large caps. Mid and small caps, I think valuations are still high, so maybe for some more time they could underperform, and so you better to do an SIP or STP. And once that phase of underperformance is over, I think it lasts for 3 months, 6 months, or whatever, I think you can do lump sum investing in mid cap and small cap as well. So this was on the market. I'll come to the mid cap fund. Before that, just one or two things I wanted to add more, which was not in the presentation. Obviously, I think one of the things which I am asked is what is the view on different sectors, which sectors you like. In that way, I think one of the sectors which is very attractive today in terms of valuation is the whole financial services sector. So we also have a banking and financial services sector fund. I think the whole sector, specifically the banks, have valuations have significantly corrected. Within that, private banks are more attractive. So I think that is one sector we can look at. I think the issue what happened with that sector is that in last 1-2 years, your inflation was very low. So your nominal GDP growth was in 8-9%. So your credit growth is linked to the nominal GDP growth. So that was also very weak. And on top of that, you had a RBI which was cutting rates because of low inflation. So your margins were also impacted. So you had a weak AUM growth because of the low nominal GDP growth. On top of that, your margins were correcting. So your NII growth for banks, which is the net interest income, was in single digit. Now going ahead, if your inflation is going up, so your nominal GDP growth will improve. On top of that, RBI is no longer cutting rates, so your margins will also be stable now. So the NII growth, which was in single digit, will go into double digit, and the valuations also very supportive. So I think things will look better for private banks or overall banking sector over next 1 to 2 years. So I think that is one sector we can look at. I think apart from that, one more sector which has corrected quite a bit. I mean, it did very well post the GST cut was auto sector, and then it has corrected now. But there obviously there is a risk to earnings because of the whole crude and aluminium and steel price inflation. But I think if there's a correction of 10% odd, I think that is one sector you can look at. We have the transportation and logistics fund. I think that is the one sector fund you can look at. Now I'll come to the mid cap fund which I manage. So what I'll try to very briefly do is try to explain my investment style, how I construct my portfolio, how do we look at ideas, just to give you a sense about how do we construct a portfolio. So just before that, I think because I started with the fact that mid caps are expensive, I think you might have a question that if mid caps are expensive, why are we even discussing the mid cap fund? So this is one slide which I like to show. Is that so? If you see the left hand side, this is the 15-year return of Nifty mid cap, Nifty 100, which is large cap, and Nifty small cap. These three indexes. And if you look at it, in 15-year, your Nifty mid cap has given a 17.6% CAGR return. Small cap has given 14.3% CAGR return, while large cap has given 12.7% CAGR return. So this is also after the underperformance of last 18 months. I mean, underperformance not, I'm sure muted return. So you look at it over longer period of time, mid caps give you very strong returns. In fact, a lot of people don't realize that mid cap returns are actually far better than even small caps. It's better than large caps, so everyone knows, but some people think small cap is better than mid caps, but actually mid caps are even better than small caps. This is point to point. But if you want to remove that volatility of point to point and just look at rolling returns, average, even there you will see the same outcome. So if you look at it, the rolling average returns of the three on say on 3 year and 5 years, let's ignore the 1 year to shorter period. If you look at the 3 year and 5 year average rolling returns of last 10 years, it is around 18% for mid cap. Again, for small cap, it is around 15.5, 16%. And for large caps, it is around 13.5%. So, whichever way, and obviously you have the standard deviation also. So, if you look at the risk adjusted return, it's actually even better. So, if you look at it whichever way, generally mid caps has given very strong returns on an average basis. So, it is very important to have mid caps as a part of any investor's portfolio because they generate lot of alpha. So that is why even though mid caps look slightly expensive compared to large caps today, and that is why we are asking you to avoid lump sum. But looking at the long term returns and the potential to generate alpha, you should not stop investing in mid caps. You should continue with SIP or STP. And obviously, if the valuations become more attractive, then you can do lump sum investing also. Now, I'll just come to my investment strategy and I'll try to give you examples so that it is easy to understand and not to confuse you with lot of jargon or words. So one of the things to begin with is that if you look at any fund manager and if you look at any portfolio, generally portfolio managers will say, some portfolio managers will say we follow a value style of investing. Some portfolio managers follow a quality growth style of investing. And then there is a third, which is the blend of both, which is both quality and value mixture. So in UTI, what we do is that we have different portfolio managers with different style. We have some portfolio managers who follow a quality growth style. There are some portfolio managers who value a value style. And there are some portfolio managers who follow a blend style. So I generally follow a blend style of investing for all my products, which is mid cap fund and focus fund. So it is a blend of growth and value style. Now, how do you make that blend style of portfolio? Is that when I try to make a portfolio and I am looking for investment ideas, I am looking for investment ideas in three types of buckets or three types of investment ideas. So one, the core of the portfolio, which we call as sustainable business. I mean, you can also think of this is the quality part of the portfolio, quality growth part. So you have quality and growth and you have value. So this is the quality growth part of the portfolio. This you will see in any quality growth portfolio manager's portfolio. Basically, these are companies which are very well run. They have a long runway for growth. They have very strong return ratios, cash flows. They are market leaders. They have cost advantage or they have some strength. So they are, and obviously valuations are also expensive. So this is the quality growth part of the portfolio. Then we are trying to generate alpha using cyclical opportunities, or basically this can be in any sector or sectors which are generally more cyclical in nature, like metals, commodities, industrials, sometimes some portion of financial, some portion of automobiles, which are more cyclical in nature. And there, if you think, we think that the cycle is really bad now, profit margins are low, and there is a scope that profit margins could improve. Valuations are low, which valuations could also improve. A combination of the both, and we will try to invest in those ideas which can lead to very strong returns. And last, we call this transformation opportunities, or also put it very simply, turnaround opportunities. Now, these are again companies which generally have been doing very well. They have a good history, but due to certain internal or external reasons, today they are not doing well. So there could be many reasons, like competition बढ़ गया, or regulatory changes हो गया, or the CEO has suddenly resigned, or there is some management churn, because of which there is some issue in the company. Stock has corrected, valuations are also cheap, and now if we think going ahead, things are improving. Say regulations are again changing for better, competition is reducing. There's a new CEO which has come, and if we think because of that the stock price can improve, then we try to invest in such ideas. So what I'll do is that I'll try to just give one example of each so that it is easy to understand. And all these examples are part of our portfolio. So these are part of the mid cap fund. So if I look at the turnaround example, which was the first one and which we have in the portfolio, is called Suzlon Energy. Now I think, I don't know how many of you are aware of Suzlon Energy. It has a long history. Anupji will remember because 2008 also it was the darling of the market. So they were doing very well till 2008. Then they did some acquisition internationally, their debt increased and they had some issues, and obviously the stock price really collapsed by almost 90%. And for a long time the stock did not do anything because they had a very huge debt, so there was lack of interest. And on the wind, so basically they are a company which manufactures wind, if you want to set up a wind power project, equipment for that. And for a long time, there was not too much investing happening in the wind energy in India. Now, what happened post COVID was that if you look at, this was the debt which was very high. Post COVID, the company reduced its debt. They also did some equity raise, and at the same time, post COVID, you saw that suddenly there was a increase in the order book. Basically, India as a country started again investing in wind power because you had not invested for a long time. So your order book increased, your debt reduced, your EBITDA increased, and which meant the stock price, which was below 10 rupees for a really long time, did very well. So I think it went all the way up to 60 rupees. Today the stock will be around 40 to 43 rupees. We would have first invested in this company around 18, 19 rupees. So I think these are the kind of turnaround companies where we try to take measured risk. We don't want to take risk in companies where there is a huge amount of debt or leverage, because then it can go bankrupt also. Here, when we saw that the debt is going down, we took that opportunity. Second is an example of the sustainable business, which is the quality part of the portfolio. Persistent Systems, again, this is a part of our portfolio. This is a mid-cap IT company. And if you look at, this is a steady company. It's not a cyclical company or a turnaround company. If you look at in last 5-6 years from COVID, it has been one of the best performing companies in terms of growth in the sector. So they had shown almost 20% plus revenue CAGR, 20% plus earnings CAGR. And that's why the stock multiples have, P multiple has also gone up, and stock has also done well. And they generate very healthy ROIC. So during COVID, the stock was almost at 200, 300 rupees. Today, that stock is close to 5,000 rupees. That is how much the stock has done well and given us returns. And last example is of the cyclical business. Again, this is a business, this is a company which is in the power equipment business. So as I explained, lot of investment in India is happening in wind power, even solar power. Now what happens is that a solar power project is put in some location. So if you have read the news, lot of solar power projects are put in Gujarat, in the run of Kutch, because they have you need lot of land for solar power. So if you are putting lot of solar power projects in run of Kutch, which is called there is an area called as Khavda. Now power तो आपने project वहाँ लगा दिया, but you will need the power in a city like Mumbai or in Delhi or in Ahmedabad. Now how do you get that power? You have to put a transmission line, which is called high voltage transmission line from there to here. Now because you are investing more in the power project, now you have to invest in transmission line also. So I'll now come to the focused fund. So a lot of it is same like mid cap, so I'll not repeat everything. But see, I think one of the things we have to understand what is exactly is the focused category and why is it relevant or why it is important. See, what happens in a focused fund is that what we try to do is that we have a good research team and they come up with a lot of ideas. Obviously, in the mid cap fund, we have almost 90 stocks because it's well diversified. In focused fund, we try to create a concentrated portfolio of 30 best ideas from our research, using our research experience. So it's obviously a very concentrated portfolio. So the holding per stock or per position is very high, which means that the risk reward is very high. So obviously, because you have less number of stocks and per stock position is high, if some of your stocks do very well, then your portfolio return is very good. But at the same time, if some of your stocks not do well, then your portfolio return can be negative. So it is more volatile with a higher possibility of return, with obviously with higher risk. So in a way, you can think of it like it is a PMS product within mutual fund. The benefit is versus a PMS is that you have better low transaction cost, you have low expense ratio, you have tax advantage because we don't have to pay short-term, long-term capital gain tax when the fund manager is transacting in the portfolio. So in a way, this is that kind of product. If any investor or has a better risk appetite and is willing to take some risk, then I think some part of his portfolio, maybe 10, 15, 20%, you can allocate to this category. Otherwise, it is like a flexi cap fund. There is no restriction on market cap or sectors. The only restriction is number of stocks.